Well, hello, everyone, and welcome to another episode of the Lending Podcast. We are your hosts. That's Jeff Jones.
Hi.
And I'm John Burnham. Thank you for being with us again today. We've got a great topic. We're going to talk about how interest rates affect affordability, how they affect your payment based on sales price, interest rate, and some strategies to take advantage of some tools in the market right now.
Yes. I'm excited about this one. It's also our 21st episode.
Oh, yeah.
So our episode can now order the finer things in life.
That's right.
But this concept of affordability is a pretty big deal for most of our conversations we have, especially our initial consultations we have with our borrowers. So the usual question is like, what's your monthly budget? And how much can you afford? What's my buying power? What price are you looking for at a house? And how's that going to affect how much it costs every month? So I think this is really timely because as rates have been really moving pretty quickly, seems like every week, there's new information from the Fed, there's new information going on in our industry. Mortgage-backed securities are moving pretty fast up and down. So with the movements of the rates as they are today, what is this going to be? June coming up here of 2024. I think this is a great time just to go over how it affects your monthly payment. Between a 6.5, 7.5, even up to 8.5 rate, or whatever the differences might be, or even buying it down to a 4.5. We're going to go over those scenarios for you today. So, how do we want to start this?
Sounds good. Well, I would say the most common question we get is, what can I afford?
Yeah.
How much house can I buy?
Yeah.
And I think there's two numbers that are real critical. It's what is your maximum, like what can you qualify for, but also what's comfortable from a budget perspective. And so our real estate agent partners out there need to know what our buyers' buying capacity is, so they can set up the appropriate search. So you're looking in neighborhoods that are appropriate for you, with the right sales price. And so that's usually the question we get is, how much house can I buy? Well, we need to reverse engineer that a little bit, because as we've talked about maybe on prior episodes, it's not really about sales price. It's really about payment. So everything we do is about payment, right? Debt to income ratios, what do you qualify for? And so the payment that you qualify for, to some degree, reverse engineers into a sales price, but it really reverse engineers into a loan amount.
Right.
So you might be able to qualify for a house price at X, and your neighbor's qualifying at a house price that's Y, because your down payments are different and your interest rates are different. Your payments, taxes are different.
Right.
One house is in a flood zone, one house is not. So there's flood insurance. So there's all these different factors. We're not going to really get into the taxes and the insurance and the HOA dues and all those pieces today. We're going to strictly talk about loan amount and interest rate. And that's what we call the principal and interest portion of your payment. And we're going to really drill down on what is the principal and interest at the various sales prices, at the various loan amounts, and how that interest rate affects those payments.
That's good. Okay. I like that a lot. As we talk to, people that are looking to buy, we have people that are renting, and they're very conscious on that monthly budget, right? Because that is how they've looked for apartments many times, has been what's it going to cost me every month of rent? And so a lot of times when we get people that are renting currently, we compare it to where they're at with their monthly payment.
For sure.
For people that already own a home and want to, move up into a different home, a lot of it is, my house is worth, $400,000. We want to get into like a $500,000 house. And so in their minds, it's almost loan amount.
Yes.
Conversation. And then we kind of tell them, this is the different monthly payments on that loan amount. But it is different to kind of see the different thought processes of that decision making. So we're going to go over how those affect.
Yeah. There's a lot of information out there in the marketplace about how, when sales prices go up or when sales prices go down with the respective interest rate market, how that affects payments. So specifically, we have a few things printed out.
Yeah.
Some props
it's
for
a
us
paper
today.
Day.
It's a paper day.
We have to.
That's right.
We don't want to misquote things.
That's right.
When it's numbers.
When it's numbers. That's right. So one of the high level comments that you'll hear out there is, if a house increases in price 10% and the interest rates go down 1%, it's about the same payment.
Okay, let's say that again. So if the house price increases 10%, so a $400,000 home would go to $440,000, and say the rate at 7.5 would go to 6.5.
That's right.
It's basically the same payment.
That's right.
Okay.
And so let's dive into that a
Yeah,
little bit.
let's get that detail.
So the reasoning behind that would be, okay, let's just say the market right now for a $400,000 home, and we're using interest rates of say 7.5%. There are lower rates available. There are higher rates out there. Depends on the product, but we're just going to use this baseline today as of May 24th, 2024. It's Memorial Day weekend coming up. Thank you for your service.
Thank you.
And thank you, all of you veterans, and especially those that gave the ultimate sacrifice. We appreciate your service. Grateful for you. So we are talking about a $400,000 house right now at 7.5% rate. Okay, and that payment is, where is that? Okay, so it is $2,657 per month. So again,
Principal and
$400,000.
interest.
That's right. $400,000 house. We're doing a 5% down payment on this. So that's a $380,000 loan amount at 7.5%. Okay, principal and interest, $2,657. Does not include taxes, does not include insurance, because those are going to be the same no matter what the interest rate is, right? We have some constants with taxes, insurance, HOA dues, et cetera. Okay, so the relation between a $400,000 house at 7.5 and a $400,000 house or $440,000 house at 6.5% is what we're diving into. Now you're at a $2,642 payment on that. That is a $15 a month difference. So let's say this again: $400,000 house at 7.5. Let's say rates start to trickle down and activity increases, because it will. We have a lot of buyers on the sidelines. When activity increases, what's going to happen to prices? They're going to go up.
They're going to go up.
Now, when the house goes to $440,000, you feel like, oh goodness, I'm paying 10% more for this house, maybe in a year or 2 years, which is true. But if rates are now 6%, it's going to be about the same payment. Okay, but you've also lost that appreciation in your home. So if you bought today at $400,000, in a year when rates go down and prices go up, you're sitting on a way more equity than if you wait. But we wanted to show you that relation. So it's not really going to kill your payment necessarily when the house price goes up, because potentially rates would be lower. You might even be able to be sitting in the same payment.
So the buying power of a $400,000 house at 7.5% compared to a $440,000 house at 6.5% is $15 a month.
$15 a
It's
month.
a Chipotle burrito a month.
That's right. Well, without guacamole.
I like
It's like 19
I love
bucks.
guacamole.
Yeah, I know you can't do it.
Yeah, guac's.
Yes, I know
I'm hitting the
guacamole costs
20s.
extra. Yeah.
Okay, no, that's very good. So, I also, our purpose of this episode is not to encourage people to wait, because we think it's actually still a better time to buy now. Like you said, build the equity, as well as the competition is way more lax right now. So you get a lot more, what do you say, not assurances that you might get the home you want, but there's just less competition. So you might be able to get more seller concessions to help out your costs. So there is other financial.
You have more options too.
You have a lot more financial incentive, I think, to not wait.
Yes, I'd say we've tipped to a buyer's market to some degree. Now, we say that at the time we're recording this, I had a client this week got under contract. She's exactly buying a $400,000 house, which is funny. It was her 5th offer. She got beat out on her first 4 offers.
It's starting to happen
in that price point, and that's where a market that we feel like is maybe softer than it has been. So there are buyers for the right property that are presented well, that have a really good online presence, that show well, that are move-in ready, that are priced right. Those houses are moving.
Yeah.
And so, yeah, I like what you said. It's not about we're encouraging you to wait. We're just simply adding that perspective that if you bought today, when rates go down, it's going to increase competition. It's going to increase your sales prices.
Yeah.
And you would have lost out on $40,000 in equity gain potentially because you waited. However, if you're not in a position to buy right now, don't fret for whatever it is. It might be credit. It might be a new business that you started, your job, your employment, your assets. You're waiting to get the down payment that you need. Whatever it is, when rates come down and you're able to jump back in the market, you're still going to be in a good position from a payment perspective, right? Now, let's talk about a strategy that we use on a very consistent basis, which is the temporary buy downs.
Ooh, I like this.
Now, we've touched on this before. We haven't really had the numbers in front of us. We just talked about conceptually, what is a temporary buy down? It lowers your interest rate for the first 1, 2, or 3 years, depending on the program. There's a 3-year temporary, a 2, and then a 1 year. Okay. And so we did an analysis on that same $400,000 house at a 7.5% rate, permanent rate. Okay, it's fixed for 30 years at 7.5. The temporary buy down on a 3-2-1 buy down would lower your interest rate to 4.5% for the first year. It would then go to 5.5 a year 2. Then it would go to 6.5. Year 4, it would kick in at 7.5 for the remainder of the 30 years. That's presuming you never refinanced or sold the house, right? It is a fixed mortgage. This is a misconception. It's not a variable interest rate. It's a fixed mortgage. The seller is going to contribute enough money to do that temporary buy down. And the payment difference in the first year is $732 a month.
A month.
A month.
That's a lot of Chipotle
That's
burritos.
a lot of Chipotle. Yeah, you get like the gold platinum membership
for life.
Yeah, for life. So your payment would have been $2,657 just for the principal and interest. Again, does not include taxes and insurance. And with the temporary buy down, it's $1,925
with a 4.5% rate.
with a 4.5% rate.
I think this is interesting. So a lot of people will see advertised rates online, and it might be a new build that's advertising rates. It might be a lender that's really trying to compete. What you got to look out for is the cost, right? So they're doing something to get down to those lower brackets of rates. We do that too. So it's actually incredibly helpful right now as people are just kind of sticker shocked, I think, by monthly payment prices. And so we love bringing options. And so it's like, great, keeping your price point of $400,000, because that's what you've been comfortably looking at. We can lower that payment by $732 a month if we and your realtor partner get together, so that when the offer goes in, that offer is already requesting those concessions to pay for that for you.
That's right.
So that's why I like these conversations up front. This is one of the reasons why we do the podcast, is so that people are informed before the offers go in. So we want them ready.
Yeah, and these buy downs can be all seller concessions or seller paid closing costs. They can also be a combination of some seller and some lender paid closing costs. So there's times where we're actually contributing to help facilitate those buy downs as well, because each program may have certain criteria, certain maximums. Conventionals usually cap out the seller concessions at less than the FHA loans. And so which loan's best for you? We're going to navigate all those guidelines. We're not going to get into that necessarily here, but we'll coach you through that on your specific scenario. So so I think this is something that we've heard about in the marketplace. We've talked about maybe on the periphery, but when prices go down, and this is the other strategy, I guess, where we could talk about is say prices go down from 400,000 to 360. So there's a house in the neighborhood that perhaps you can get some value out of. You can make an offer that's lower, below market. Again, I just touched on a buyer who had 4 multiple offers and lost out, and she got the 5th one. So not every property is going to be able to be negotiated down that much.
Right.
But if you've got a 10% reduction in price, that's equivalent also to a 1% increase in rate. So you could, in theory, pay a higher interest rate at that lower price and still have the same kind of payment. And so we just want to give you that perspective on, it's not all about the interest rate. Of course, it's super important. It's one of the components that is very important when we factor in. The main thing is, what is your budget? What's most comfortable to you? And what's the right strategy with your home purchase based on your timing and based on the proposed market movement that we think is coming in the next year or two, right? And does it make sense to wait? Okay, there are some circumstances where maybe it's not the right time for you, but I think 9 out of 10 of our buyers, if they could find the right home, should be buying right now, because when rates go up, you're going to be happy you got that rate at maybe 7 or 7.5, because now rates are 8 or 9%.
Yeah.
And if you get in the home and rates come down, buyer activity is going to increase. The homes are going to appreciate. You're going to be able to refinance, and you're going to be really happy you already own the home.
Right. And maybe get rid of your mortgage insurance.
That's right. Yeah.
Because you got more equity now than what you bought for.
Yeah. That's right. That's right. So I think we could unpack this. Of course, we could do this at different price points, but it works the same. Take a $750K house and a 1% reduction in interest rates equal to the house being $825,000. 10% more in purchase price. So it really works at every price point. And I think there are some circumstances we could agree in greater Central Texas here. We saw the peak back in spring of 2022, about 2 years ago, is kind of where we saw the home price peak for some of our area, for some of our neighborhoods. And you could argue that those prices are reduced from the actual peak, but we've really seen a nice appreciation level over the last couple of years. Slower appreciation, but still some appreciation year over year. And so we just haven't seen whatever the news channels prognosticated was going to be a crash. We haven't seen it. And the reason we haven't seen that is because the job market's strong, the employment numbers are good, and people are buying homes, and their lifestyles changing. They're right sizing, or they're buying homes because their family's growing, or
Right.
they're selling and buying something else because they want a second home. And so we just continue to see activity across the board.
Yeah. No, that's good. I like that a lot. And I think, when it comes to if prices are going down or going up, a lot of people think prices are going down because a house might be listed too high in value, and so a house that's like, hey, I'm going to list this house at 500,000, when the appetite for that square footage, that location, that age of the home, the build quality is more in the 425 range for that property right now. And so a lot of it might just be people thinking, the listing initial thought is just too high of an ask. Um, and so when they're right priced with your realtor can talk all day about this. They love these conversations. Is when they list it right priced, it is instant demand for that property.
Yeah.
And those are when you get a lot of competition.
Yeah, most of the time when a house is sitting, it's because it's overpriced.
Yeah.
Or maybe it doesn't show well. Maybe the homeowner has pets or who knows what in the
Fuzzy
home.
photos.
Fuzzy photos.
Yeah.
Yes, that can be a deterrent for
Yeah.
sure. So there's a lot of things that we're seeing out there. But for our position today, when we're walking through these strategies with our buyers, we want you to know there are so many different conversations around and so many different strategies around your specific situation. Your situation is different than the next person's.
Right.
And so it's really customizing the solution for you. We talk about that a lot, and really talking through, should I buy now? Should I wait? What are the pros and cons of both? And we'll coach you through that,
Right.
and we do have I have some clients right now that they have to wait. They just started a brand new business. They're 5 months into their business. They really need to finish out this year, file their tax returns, and buy something next spring. And so unless they have a co-signer, and there's always a way too where we can bring in, well, what about this option? What about that option?
Mm-hmm.
So just because you've maybe had a life change recently, and we talk about this a lot, please do not disqualify yourself, right? Let us coach you through the way to get it done. There's always a way to get it done. We just have to figure out how.
Good. I like this. And I know that we went over scenarios today that is hard to visualize sometimes just when we start spouting out numbers, rates, price points. So if you ever do want a scenario made for you and you live, in Texas, we would be happy to do that for you here at Benchmark Mortgage with JB and myself. But, we're here to have the dollars make sense. That is a ridiculously dad pun I just made up right there.
That was good. I
Yeah,
didn't
my
even
kids are
catch
going to
till you
love
said
it.
that. Yes.
Okay, so thank you so much for watching the Lending Podcast and listening to us on Apple Podcasts also. So if you can subscribe, share, we would be honored for that. If you have any comments, please leave those for us. We do look at them. And I think that was a good one.
Thanks for being with us today.
Thanks for being with us.
We'll see you again soon.
Okay.